Welcome, everyone. So we're having a very intense Sustainable Friday today, like the events team named it. So this event is focused on a special kind of green bonds called sovereign sustainability linked bonds, and it's being organized with NatureFinance, Simon Zadek, who is sitting right here to my left. And so Simon and I have been engaging on this and other related topics quite intensely over the last 3 years or so. But this is the first time we've met in person. So that's really great. So we have a very star-studded panel, starting with Simon, who is the head of Nature Finance. And they have recently expanded and actually created a hub which is devoted specifically to this type of financial instruments. We also have Aaron Kuhlenkampf in the audience, who is in charge of that hub. We then have Alex Lehmann across from me, who has been working on green finance for Bruegel, and together with our colleague Katharina Martens, they have a very nice paper that was published last week on this very subject. And by the way, I forgot to mention, Aaron's paper on the same subject for NatureFinance is being launched now. I think it's being published as we speak. So this is sort of the launch event of that paper. So we have two papers that are both, I think, rather more ambitious and deeper than one usually sees in this field, and they're going to be briefly presented by Simon and by Alex, respectively. And then we have two really fantastic discussions. We have Caroline Harrison, who is the head of research and market intelligence for the Climate Bonds Initiative. And I'm told that Caroline basically invented green bonds when no one was thinking about them yet. And then we have Fiona Stewart, who I've also interacted with quite a bit during the pandemic, who is basically the brains of the World Bank behind this type of sustainable finance. So she is a lead financial sector specialist at the World Bank, has been there for about 3 years, and before that she worked for the OECD and also in the private sector as an asset manager. So the way we're going to do this is we will give each of the panelists about 5 to 6 minutes for a first round. Simon and Alex will give an overview of the two papers that I mentioned. We're going to hear comments from Caroline and from Fiona. Then I may ask a few questions, and then we'll let the audience come in. And as always, we're hoping for questions from both the in-person and the online audience. And if you want to ask questions online, please do so on Slido. And the term, the keyword, whatever you call that thing, is called #sustainability. The code is #sustainability. Over to you, Simon.
Jeremy, thank you very much indeed. And it's very nice to meet you, finally. It has to be said. And I'm really pleased to be co-hosting with Bruegel this discussion. It's a topic, as Fiona and others know, has been sort of lurking in the labeled bond field for a few years, and I think is beginning to emerge into the light. So the launch of our paper today is a sort of another step for us in this direction, and I'm just going to summarize one or two of its aspects. I think, notwithstanding, I'm sure, the fact that everyone in this room and online kind of understands the context that we're in, I think it's helpful to reinforce the context of that nexus between an emerging market sovereign debt crisis, the kind of associated and unassociated links to poverty, food security, and of course the connections across in the short and longer term to the climate and nature challenges. And I would hope that it's fairly simply said that the downside version of that story is not just now, but has the potential of driving us into a vicious circle where increasingly countries that are at risk find it difficult to access sovereign financing difficult to make investments in improved resilience and productivity, and so begin to spiral downwards. I think a very real possibility at this point. And so our collective challenge, if you like, is to ensure that that vicious circle doesn't grab us too harshly, and to instead create a virtuous cycle that allows us to address what so far have been quite unrelated policy agendas, which is the sovereign financing side and the way that plays in particular through capital markets, the climate and nature piece of the story, and the link ultimately across to the health and state and security of individual citizens, so poverty, food security, and so on. So how do we connect the dots between this interrelated set of policy agendas? Obviously, historically, we've tried to do that at the policy international architecture level. That's proving to be quite difficult. And so it's in that context that we begin to talk about sustainability-linked sovereign debt, that attempts to connect together these different elements into specific financial instruments that, in their simplest form, offer a reward in terms of a reduced cost of capital, reduced debt servicing costs for agreed sustainability KPI-driven outcomes. Could be nature, could be climate, could of course be other aspects of the sustainability agenda. This is not a new idea. It's lurked around in many shapes and forms for many years, but we've seen, particularly in the last 2 years, what I would call the beginnings of a sort of fairly conclusive proof of concept stage. We've seen individual bonds coming from Chile, coming from Uruguay, that have, albeit fairly small, step ups or step downs, slightly different for the two cases. And then also another set of sort of proof of concepts, if you like, in the sort of KPI sovereign financing space, with the refinancing models that have been played out in Belize and then in Barbados, involving, in that case, concessionary financing to improve the investment grade of the bonds concerned, unlocking funds, which then flow towards achieving certain agreed KPIs. So this is not only about individual KPI-linked bonds, which is why the sustainability-linked sovereign debt hub is called a debt hub rather than a bond hub, if you can look at it that way. So we're looking at many ways in which sustainability-linked performance models can be attached to various different approaches to sovereign financing. So if we've, in a sense, established a degree of sort of proof of concept in the market involving policymakers in some instances over the last couple of years, the question is, where does this go? Is this a little niche play, which will be interesting here and there, or is this something that could scale, and if so, how, to become a significant, if you like, cluster of instruments and approaches to addressing this nexus between these different kinds of crises and desired performance outcomes? The report NatureFinance, with the sustainability-linked sovereign debt hub, launches today, is entirely focused not on those proof of concept examples, but more on whether and if so how this whole domain can be scaled effectively, and with what possible effect on reducing debt servicing costs, particularly for us, of emerging markets, particularly low income countries, but also, of course, linked to this question of how we address broader nature and climate objectives and ensure investment streams in improved resilience and productivity. The 7 pathways I'm not going to go through, obviously, in detail in the short time I have at the moment, but just to say they include, if you like, what you would expect. We need to build standards and common ways of using KPIs, and we're beginning to work with ICMA, for example, co-chairing a working group with the World Bank in that area, but perhaps also beginning to stretch into kind of other more complicated pathway routes. For example, how do you link together KPI-linked sovereign debt instruments with, for example, voluntary carbon markets or emerging biodiversity credit markets? So how do you begin to build, if you like, performance-based financing ecosystems of which the debt part is only one part. And also, at the moment, for example, there are discussions going on around the so-called JETPs, PCPs, and FLIPs. These are all acronyms that I'm assuming you know. Actually, I'm just sort of joking, but effectively are the international initiatives, particularly coming from OECD countries, to try and channel larger scale funding to address climate and nature challenges, JETPs being in the climate space, and now we have from the French, the British, the Americans, and the Europeans, these PCP flips. Kind of where can these sorts of sustainability-linked debt instruments fit into these sort of large-scale initiatives that are emerging as we speak? I wanted just to touch on one other of the 7 pathways that we've laid out in this paper, which is the role of credit enhancement, already mentioned a couple of minutes ago in the context of the initiatives that have supported refinancing linked to KPIs in Belize and Barbados. It seems clear to us in the context particularly of the emerging market debt crisis, where you have such a large volume of distressed debt, that the role of credit enhancement to push up the investment grade, link some of the unlocked funds from that process to specific nature, climate, and sustainability KPIs is an opportunity and a need that should be advanced over the coming period. And part of what the paper sets out, and a related paper on credit enhancement that we've released a couple of months ago, is kind of how one might begin to build a sort of pooled approach to credit enhancement that brings together many multilateral development banks and potentially sovereigns on the, if you like, on the buyer side, that could support a growth in the availability of that resource. Briefly, a couple of things to just finish off these opening comments. The paper has taken, I would say, a brave stab at what the size of the market might look like between now and 2030. It's by no means a projection, if you like, or a sort of this is really what it's going to be. It's more a kind of estimate as to what its potential can be and what it would mean to pursue some or all of these 7 pathways effectively. And I think the point simply we wanted to make is that the scale can be substantial. It can lead to significant reductions in debt servicing costs of debt-distressed countries, and can significantly support addressing directly climate and nature objectives, as well as ensuring an open pipeline of investment into improved resilience and economic productivity. Challenges, there are many, and I'm sure Jerome and you will push us to discuss some of those challenges over the rest of this session. Greenwashing, discuss. Materiality and relevance, discuss. How do we ensure that the private sector is interested in this? Maybe that's something, Alex, you'll come back to, given the strength of that in your paper, and how to really build out, if you like, the political will to mobilize resources in the credit enhancement and guarantee space. So all topics we may want to come back to in discussion. Last point, is this something purely and simply to take forward in the context of a crisis? We would argue no, that when one looks, if you like, at a broader chapeau question, which is the future of sovereign financing in the context of increasing climate shocks to the system, we think that these sorts of instruments can play a role in that broader context. Jerome, back to you. Thanks very much.
Alex, you have the floor.
Okay, thank you. And really pleased our 2 papers come together here in this event. So thank you for inviting Katharina, my co-author, and myself to present this here. I guess the overarching question in our paper is, how can sustainability-linked sovereign bonds become an asset class in their own right, which as yet they're not. We have had 2 issues by Uruguay and Chile. We've had a sort of bunch of roughly 200 corporates, mainly in Europe, issuing these instruments. We have the transition bonds, which are related but without a financial link in Asia in particular. But it's still a very emergent, nascent, poorly established asset class. inflation-linked bonds are an asset class in emerging markets as much as in the OECD, and I think there's quite a bit to learn from that. So our question really was, is this something that could not just be desirable from policy standpoint in Europe, but is it feasible, is it practical given the shape of sovereign bond markets in Europe today? And we chose Europe because we know there's a significant expenditure program. We give the estimates in the paper, roughly 1.8 up to 1.8% of annual public sector expenditures related to Green Deal transition, and largely related to mitigation. To be funded largely, we expect, in the sovereign bond markets, which work quite efficiently in that you have good trading structures, settlement structures, primary dealers. It's a very transparent, probably the most liquid bond market segment in the Capital Markets Union. And of course, there's transparency of the targets of where countries stand, and we make the point in the paper that there is an overarching policy aim, but there's national policy implementation. So that ties in with the national competence in fiscal and also debt issuance management that we unfortunately still have in Europe. Now, to date, the instrument of choice have been sovereign green bonds, very popular. 13 countries have done that. The UK came out with a very significant issue in 2021. Now, we make the point these helped issuers establish themselves with a green agenda. They're heavily subscribed. It is not for me to say that they didn't meet a investor demand. But we argue that they're not really scalable. They are, as a use of proceeds structure, the issuer is committed to certain expenditures. They're not really suitable for a large-scale public expenditure program, as will be required in Europe. In particular because there are problems around the fiscal management, the way that management offices collaborate with other parts of the government. And we already hear that many issuers in Europe are really strained by identifying the projects that meet the taxonomy and tracking them, reporting on allocation and impact, as they should do in a green bond structure. But the broader ambition that they seek, which is the climate transition, is not really captured by that instrument, nor should it be. It's a use of proceeds designed to mobilize certain spending. We, of course, agree sovereign sustainability-linked bonds are desirable from a policy standpoint. They give that transparency, that credibility, that commitment. They would be scalable. They would meet a capital market gap in that there isn't really that outcome-based contingent instrument that ties the climate outcome to the financial structure, and thereby they meet a gap in the financial market instruments, and that there is that link of a climate outcome, and that gives investors a protection that a certain transition risk will not materialize, or else that they would be compensated should it materialize. Yeah? But really, the main point in our paper is that they could be feasible, and that's for three reasons. First, the investor motivations are shifting. We see, obviously predominantly sort of a passive index tracking investment behavior, but increasingly we see that investors look at both physical climate risks, so the way issuers may be impacted by the onset of climate disasters, but also climate transition risks. Yeah, and these could have tangible impacts in terms of devaluing the public assets, impacting growth, and there are significant numbers. MSCI has come up with estimates of how OECD issuers could be impacted. So these are significant risks, both in the sort of medium term and in the long-term maturities. So investors seek a protection against that. They want to hedge against that disruptive transition scenario materializing. And they're also mandated to target certain climate outcomes, so climate alignment in the extreme and net zero target. Yeah, so we go a little bit into what's happened under the Glasgow Investor Alliance. Investors set themselves net zero targets for their portfolios. Largely, so far, that's corporate bonds, real estate, and equities. There are good measures out there how to do that. There are sort of near-term targets for a reduction in the carbon footprint, and that change is now coming to sovereign bonds. So investors will now capture the sovereign carbon footprint and seek a reduction in that. And sovereign sustainability-linked bonds could be an instrument to an asset that targets that climate alignment outcome. Yeah. So that shift is ongoing. I think we give some evidence how significant that is. It's certainly gaining momentum, so that will favor SLBs in the advanced country context, where the sort of established investors will be increasingly keen to gain exposure to such assets. Now, on the issuer side, we say essentially there is an information problem. The issuer cannot credibly signal its commitment to a certain climate outcome. Yeah? So the green bond, which was sort of an instrument to do that, is not really designed to signal a certain climate policy. It gives a certain linkage to climate spending, albeit a weak one, to climate outcomes. And the investor has no remedy to enforce that climate outcome should the issuer, the country, decide to do otherwise. Yeah? So the corporate bond market shows that investors reward good and credible climate outcomes that are disciplined. Yeah? So in an ideal structure, I think it's intuitive. You want near-term targets that are ambitious. They go beyond what the issuer would have done otherwise. And they're also enforced through sizable penalties, so certainly going beyond the 25 basis points or so. That's sort of the coupon step up in the market now. In that case, the empirical studies at least show that investors are prepared to pay a greenium. Yeah? So they are rewarding climate outcomes that are tied down in the financial structure of the bond. So from the issuer side, there is something to gain. And then our last point is, in Europe, we have a transparent policy framework. We have transparent targets and KPIs that can help markets monitor that, because I think ultimately, bond investors are very, straight-laced participants in the financial market. They seek simple structures. Yeah? So we need a clear outcome, a clear KPI that's easily monitored, because ultimately it will need to be priced on an ongoing basis in the markets. Yeah? So with that context, we think the market will be receptive. We give some suggestions how it could be done. Ultimately, again, it needs to be down to every individual issuer. The EU itself is committed to the green bond structure, so I don't think that can shift easily. But at the national issuers level, I think there is that potential to make that commitment in certain states, possibly going beyond the EU targets, and we believe and document, I think, that investors would reward that. Yeah.
Thank you. So just to recap, so the idea is that European sovereigns should issue a special class of sovereign bonds which involve financial penalties, or conversely, lower borrowing costs, to the extent that the climate targets, the decarbonization targets that they have committed to anyway, right, within the current EU decarbonization framework, are either exceeded or fall short, right? So to get a financial set of incentives that's behind this target, making decarbonization more credible. Caroline, please, your views on both and anything you might want to add.
Hello, hi. Well, I am Caroline Harrison. I am the head of research at Climate Bonds in London. And I have recently worked on 2 papers that are relevant to this topic. So the first paper is our annual State of the Market paper for 2022, which is going to be published in mid-April. And that discusses the shape and size of the global GSS Plus debt market, as we like to call it. So just to sort of contextualize this discussion, I'd like to give you some numbers around the shape and size of this market. So the total size of the sovereign GSS Plus market at the end of 22 was 320 billion. And there were 43 sovereigns participating in that market. So 43 sovereign issuers have bought green, social, sustainability, or now sustainability-linked bonds to the market. And of that, 3.5 billion now is labelled as SLB, thanks to Chile and Uruguay. So during 2022, there were sort of 3 developments that we thought contributed to a more inclusive sovereign market. The first one was the introduction of inflation-linked bonds from Hong Kong and France. The second was the introduction of short-dated paper from Austria. So Austria was the first sovereign issuer to stick a green label on their short-term liabilities, by which I mean their 3-month T-bills. And then Chile and then Uruguay shortly after established the sovereign SLB market. So these 3 developments, essentially, what do they contribute to the GSS market? Well, they contribute more opportunity for investors to green larger parts of their portfolios. So, you know, if their investable opportunity set is increased, more investors are likely perhaps to consider dedicated investment mandates. But, you know, we know that the problem in this market at the moment is not a lack of investors. There are plenty of investors. And the reason why we know that comes from the other type of work that I do, which is green bond pricing in the primary market. So we know that issuers of labelled debt, be it green, social, sustainability, or SLB, are often able to achieve cheaper pricing in the primary market, i.e., they are able to get a greenium on their new debt. It prices inside their existing yield curve. And the reason for that is purely related to a lack of supply. So what we want to do is, you know, encourage more issuers to come to the market to meet this demand, and at the same time address sort of the climate issues. So as I think it was Alexander correctly pointed out, while there are many, many sovereigns now in the green bond market, they may be running out of expenditures that they can attach to green bond use of proceeds. Often what we see actually is that when sovereign issuers come to the market with a green bond, they put, you know, they find all the expenditures that they can and they attach that to the use of proceeds. And then if they see that they get cheaper pricing in the primary market and perhaps the bond remains inside the curve in the secondary market, which means that when they reopen the bond, they also benefit from the cheaper pricing, then the DMO will encourage the ministries, the various ministries, to look at more projects, more expenditures that can be classified as green to put into more bonds, so they can issue more bonds with that label, because it makes economic sense for them to do that. So the activity of issuing a green bond encourages, or can potentially encourage, you know, more green bond issuance in itself. But there are some cases where governments just don't necessarily have adequate expenditures to justify returning to the market with green bonds, and one of those examples I think is the Netherlands, and I've heard conversations that they are potentially considering using the sustainability linked bond structure because they have run out of green expenditures to increase their existing offering in the market. So, you know, one of the things that we hear a lot from the investor side is, you know, doubts about the credibility of the sustainability linked bond structure. That is something that Climate Bonds is seeking to address at the moment. We have recently launched, or we're about to launch, an extension of our certification scheme to include entity level certification, which will extend to sustainability linked bonds. And the next piece of work that we do will be to determine a standard for sovereign certifications so that we can certify sovereign SLBs. So we will look in detail at the ambition of the climate mitigation performance targets that will be linked to the SLB and the transition plans that support them in a very similar way that we do for corporates, because, you know, underpinning any credible sustainability linked bond is a robust transition strategy, you know, that describes how the issuer, be it a corporate or a government, is going to get from A to B. How are you going to get there? How are you going to turn your ambition into a reality, you know? So what does require a bit more thought for sovereigns is their equivalent to the safeguards or commitments of the parent group. So i.e. What we will look at to provide a sort of minimum safeguard level of climate performance for the sovereign issuer as a whole. But that is not my personal area of expertise, but my colleagues in the standards and certification team will be looking at that soon. So that will hopefully bring a bit more integrity to the market. And the other thing, of course, the other sort of mechanism that is currently in the market to help to bring more harmonisation and standardisation to thematic bond reporting is, I'm just going to mention the Green Bond Transparency Platform from the IDB, which supports investor decisions, you know, records granular data for use of proceeds bonds and whether those expenditures have been made and how, and, you know, also could, for SLBs, monitor the evolution of the performance targets and the impact metrics. So, you know, there are sort of initiatives in place, if you like, to monitor the integrity of these products. And I think, you know, the market now is starting, and obviously once sovereigns start to get involved, that will bring more scale to the market. At the moment, the total size of the SLB market, including the two sovereign bonds, which, as I've said, combined are worth roughly sort of $3.5 billion. The combined size of the total market, corporate and everything else, is just over 200 billion at the moment for SLB. So it's not massive, but obviously, as we've said, it's a very inclusive market, and it does have the potential to grow.
Great. Thank you very much. Fiona, you have the floor.
Thank you. And great to go last. Let me react to some of the very interesting and rich discussions and comments made so far. So, Simon, I think you've laid out very well the sort of theory of change of why we're looking at these instruments. And a lot of the work that we've been doing, as you know well, on the ESG and sovereign bonds, is that we found that the E in particular is very badly, or not really, factored into sovereign bond analysis. And this is particularly harmful, if you like, or an issue for the countries that we work in, our emerging markets, which have the incredibly rich natural capital and the assets. So you're looking at sort of the risk side of climate, etc., but you're not really appreciating the assets, and the mitigation and the adaptation work that a lot of our countries are doing is just not being factored well into the market. So that's the sort of, as you say, the kind of theory of change around the sovereign debt, very high cost of sovereign debt, etc., that's challenging an awful lot of our countries at the moment. And then there's several tools. We're kind of looking, I kind of call them Trojan horses, of how you start to get that, really starting to get markets and investors to think about and reward and recognize the really good work that countries are doing to defend those assets and to really put themselves onto the transition pathways, as you said, Alex. And you alluded to several sort of these tools. You mentioned passive investing and indexes, and there's very good work going, for example, FTSE Russell, that have trillions of dollars indexed to their sovereign bond indexes. These sort of tweaking and ranking and weighting of countries, they're starting to redo their methodology, which really starts to bring in natural capital. It really starts to look at some of these inherent income biases that are in a lot of the ESG indicators that I think will be very interesting and very supportive of emerging market debt. So that's one of the sort of Trojan horses, is through rankings and indexes. Another is the credit ratings, very key, as you mentioned, Simon. And again, some of the credit rating agencies are now starting to look at things like natural capital and how that fits into the materiality, particularly over the long term, of how you look at debt sustainability. So it's another kind of Trojan horse that's starting to move. And then also the engagement and the reporting. There's so much going on in sustainability reporting with the ISSB, etc. at the moment. And really good work from groups like IPSASB, the public sector equivalent board, to say, do we need a TCFD for sovereigns? How do we get this across? How does help debt management offices, the DMOs, explain what their governments are doing in terms of this kind of stewardship and the transition pathways, methodologies for measuring those? And certainly Uruguay and the minister and Herman at the DMO have been incredibly great advocates with their SLB, using that as engagement to really get across the commitment and the messaging and the policy that the country is doing towards its GHG emissions and to its stewardship of its forestry. And then we come on to these instruments. So how can we use these performance-based instruments to really recognize and reward and start to get this factored into the markets? The sustainability paths, the natural capital protection, etc. And this is, as you said, Simon, it's not new. I mean, we have concessional lending, and German knows very well the IMF policies. Sustainability-linked loans are very big as well on the loan market, particularly gender loans, for example. And then we've been working with the World Bank instruments on these rhino bonds and other instruments. So it's not new, but it's putting it into the context of the really mainstream, large sovereign debt markets, which, as Alex has said, this is how we're really going to get to scale and really start to move. So a couple of things that we've been looking at. One is on, and Alex, I'm interested, you mentioned this, you alluded to the step up, step down. And we do have to learn, I think you're right, Caroline, from the corporate market. And one of the things I'm worried about at the moment is a little bit of throwing the baby out with the bathwater, because there's a lot of questions about the corporate market at the moment. They've had this, because the first one was this 25 bps step up, this seems to have become randomly the standard in the corporate market. Our IFC colleagues have done a lot of very good work looking at these bonds in detail, and a lot of them are very callable. And then we're now seeing, how stretched were these commitments, and if there's a danger that you're not going to meet them, can you just call the bonds? So there's a lot of questions about the credibility in the corporate market, which I think we need to really think about very, very hard if we're really going to grow the sovereign market. That's some of the work we're doing around the KPIs. Simon, you mentioned obviously with ICMA, the capital market standards, and we've been doing some very interesting modelling around with several countries around what really is ambition and is feasible around sort of reforestation. What would you expect anyway, given a sort of country's macro? And then looking at that and versus other peer countries to really try and do some more robust sort of modelling behind what really would ambition mean. And then there's this whole question, Alex, on the step up versus the step down. Now, you've mentioned the idea of the step up as being almost like a hedge for investors if a transition risk is not accounted for. I have a personal view, I would say. My Fiona view is that the step down is really what's going to be very, very powerful for emerging markets to really get this cost of debt down. And to me, that just seems to be a much more aligned instrument for what we're trying to achieve. So it seems very strange to me that you would pay private investors more if a country misses its NDC target, for example. It doesn't kind of align. The question is then, will investors pay for a step down? And Caroline, that comes back kind of to the greenium question as well. I think there's going to have to be, this is where concessional finance comes in, whether it's credit enhancement, whether it's some using third parties or donors or et cetera to start to pay for some of the performance, a piece of it. And then hopefully some of the investors will come along with that. So I think that's part of the credit enhancement sort of goal. And that's where we've been working on some instruments along those lines with some governments and with some national development banks. I think could be quite interesting issuers as well in countries. Can we use some credit enhancement sort of from the bank, really help them set robust KPIs, and then help them come to the markets, domestic and international, hopefully, with around these structures. We've also been thinking around what could a fund look like. So IFC colleagues, many of you will know the Amundi sort of green bond fund, Caroline will know very well, which has been very, very helpful for the scale that Alex is talking about and getting investors into emerging markets. They wouldn't necessarily have gone directly into emerging markets, but come through a fund. Could you think of an SLB kind of fund where you had a group of countries that signed up to KPIs, let's say around reforestation? Investors would then, you could be secondary market bonds, it could be new bonds, that sovereign bonds that are purchased with donors or with concessional finance coming in, with tranche the fund, and some of the first loss would take maybe a lower cost of capital, but feed some of that back into the performance payment of the countries that have signed up to the KPIs as part of the fund. So we're trying to think of whether that's the way to scale rather than going one by one by one. Could you actually do it on a sort of on a fund basis? Is another way we're thinking about scaling. So those are some of the ideas that we've put forward. Very happy to discuss, but really, really great to see these papers coming out, and looking forward to continuing the discussion. Thank you.
Wonderful set of initial comments. So I'm going to ask the panel two questions that follow up on some of the things that have been said. So my first question, which is mainly, I think, for Caroline, but others are, of course, free to comment, is, so what is the evidence on greeniums for, I mean, maybe more generally, for green bonds at the sovereign level, but then also for sustainability-linked bonds, possibly at the both at the corporate and at the sovereign level. So in particular, the two bonds that have been issued, Chile and Uruguay, was there a greenium there? Were they inside the curve, or are they inside curve now that they're trading? Primary, secondary, if you could maybe comment on that. And then related to that question, so that's just an empirical question, sort of more at the conceptual level. You know, fundamentally, there are three ways, I think, in which the borrowing costs of sovereign sustainability-linked bonds could be lower. One is obviously a credit enhancement, so that's kind of, you know, easy. If someone subsidizes it and de-risks it, that's going to be then cheaper to issue. The second one is that there is sort of an intrinsic investor interest in supporting the action that is being promised in that instrument. So the KPI in itself is somehow attractive to at least a class of investors, maybe because they are shareholders or the general public support them. So maybe this is the case for some conservation projects, for maybe rhino bonds, I don't know. But then the third one is that the actions that are linked to the KPIs actually reduce sovereign risk, which I think was the claim of both Simon and Alex. And so maybe Simon and Alex could explain, and I would like Fiona also to comment on this, or both of you, Fiona and Caroline, on how strong is that channel? How would you have to design the KPIs for that to work? I mean, I imagine a lot of this is country-specific, so the existence of transition risk at the country level probably has a lot to do with the economic structure of that country. There are presumably some conservation projects that are very strongly linked to the ability of the sovereign to repay, but in general, perhaps less. There may be climate adaptation. So, you know, this has a lot of implications for both who can hope to benefit in this sense from issuing sustainability-linked bonds and how one designs it. And so far, I'm not completely sure that I believe the analogy between transition risk at the corporate level and at the sovereign level, because with the exception of some countries that are highly dependent on fossil fuels, I think sovereigns are much more diversified as entities than corporates, and so while at an abstract level, of course, sovereigns do face some transition risk. There's maybe the risk of turmoil in the financial sector if in some tail events. I really find it very hard to believe that even if a country like Poland would issue a large amount of sustainability-linked bonds that then strengthens its commitment to its decarbonization goals, it would actually reduce its borrowing costs as a result. So this is not entirely plausible to me, but you should all comment, please. So maybe we start with Caroline, if that's all right, on Migrenium's question and whatever you want to say.
Well, one thing that was a huge benefit to me in the pricing work that I do was the introduction of the twin bond structure from Germany, which has also been, I think, modelled by Colombia as well when they issued their green sovereign. And what that has done is enabled a very clear and transparent comparison, if you like, of the green label versus bonds with the same characteristics that do not bear the green label. And we consistently see that Germany's green bonds are coming inside their vanilla yield curve, and they are staying inside their vanilla yield curve in the secondary market. When Colombia modelled this, they had the same result. So we don't always see agreenium on sovereign debt, but that said, there's a lot of nuance to modelling sovereign curves. The timing is a big input because the prices can be so volatile on markets with that degree of liquidity, so it's all about capturing the data at the right moment. But where we have these clear possibilities available, we are seeing consistently pricing benefits for green bonds in both primary and the secondary market. When we talk about the SLB market in general, that's something that we have recently started working on because obviously the market's been so small. One of the idiosyncrasies, if you like, of the SLB market is that the issuers tend often not to be huge debt issuers, so it can often be hard to build a yield curve for them and then make that observation. But for those that we have been able to look at, again, we do see bias towards pricing benefit. We've done 2 studies now that have included SLB pricing in our most recent pricing paper, and also the one that we published in September of 2022. And in both cases, we were able to observe pricing benefits for SLBs. For the 2 sovereign SLBs, the Chilean SLB, we did not see inside the yield curve, and nor did we see the Uruguay deal come inside its curve, but the Uruguay deal in the secondary market is firmly inside its yield curves, which suggests that investors appear to like that structure. But just to come back to one of the points that Fiona made on pricing, actually, just to reiterate that really, we hear a lot from emerging market issuers who want to know whether or not they can be guaranteed agreenium if they stick a label on their debt, because obviously there is a bit of extra commitment required, if you like, for them to do that, and they want to know whether or not they're going to get compensated. And obviously we can say, well, you will attract more investment, and all the other benefits that issuers get from going through this exercise. But we say, it can never be guaranteed. It depends on the day. It depends how the market's doing and things like that. But this idea of the step down, therefore, is, as Fiona highlighted, indeed a very important potential draw for sovereign issuers and sovereign issuers of SLB. So yeah, just to sort of end on that point, really.
Caroline, say a little bit about just the order of magnitude, if you don't mind. So when you're talking about, so we have three classes, right? We have the sovereign SLBs, where so far we have not observed agreement, certainly not in the primary market. Then we have the corporate SLBs, and then we have just the twin bonds, right? Say, which are use of proceeds, and in the case of Colombia and Germany, we can actually compare directly. So can you just say, are we talking about 5 basis points, 25 basis points, 100 basis points?
No. On the German, it can be like between 1 and 2 basis points. It's not very big, as one would expect for a large liquid market like that. I think Colombia saw something like 6 to 8 basis points, and I think generally in the corporate market we calculated, broadly speaking, 8 basis points.
Thank you very much. I cannot resist a comment on step down and step up. Is this really a relevant discussion? I mean, once you put in a step down, the normal becomes the step up, right? I mean, there's an equilibrium. You price it differently, so
Yeah.
I don't think it really matters whether you do step down or step up, no? I mean, isn't there some sort of basic neutrality about market pricing that says it's irrelevant? So if you only have a step up, you're going to get the step down in the sense of having a lower cost when you issue it. But anyway, maybe I've misunderstood something about this.
I don't think SLBs are being priced in that way at the moment. I know what you mean from an intellectual perspective, but from a practitioner perspective, they're just being priced off the normal yield curve at the moment. The optionality is definitely not being priced in right now. That may be further down the line, but the pricing model is not that right now.
That is a problem, no? Because that's the whole thing. We want that optionality to be priced. No? Okay, then on the conceptual question. So how do you have to design an SLB so it actually reduces sovereign risk? Simon, do you want to take a crack at that?
Okay, so I heard the original question in a very slightly different way, but let me give it a shot. So you offered three ways of doing it, and I just wanted to comment on the first two briefly before turning to your main point, which is the third. So firstly, credit enhancement or other ways of playing into sovereign debt markets. Yes, you can look at it as a subsidy, but actually you can look at it as a use of public money for buying down public goods, which is the point of the whole exercise. And so the question, so the critical question that HM Treasury and many others have asked us is this the most cost-effective way of buying down those public goods? And I think that test question remains outstanding. I don't think the analysis has been done. HM Treasury and others go, can't we just give it to them in a check and transfer the money to their bank account and build some trees, as opposed to running it through sovereign debt markets? And I think that value for money comparison hasn't happened yet, firstly, but needs to be done. But just to sort of put it as a public good buy down rather than a subsidy, I think is a more helpful way of thinking about it. Then on the intrinsic side, again, your point is well taken. Let's not forget the growth of impact investing in its broader sense, not just in its niche VC sense, the growing importance of double materiality in all sorts of regulatory environments, so that becomes another driver. The growth of litigation, also driving one into an impact analysis, and the beginnings of a set of regulatory pushes such as the deforestation due diligence requirement coming out of the EU, the UK, and the US, all of which is sort of pushing one as an investor into that impact domain as a risk, a litigation risk, a pricing risk, and so on. So I just wanted to not lose the fact that that second category of yours is not independent of risk, but is actually, there's a sort of ecosystem of impact and risk that relate to each other quite clearly. And then on your third point, which is the so-called virtuous circle as we think about it at NatureFinance and the sustainability-linked sovereign debt hub, clearly, does it or doesn't it work? Maybe two or three, not so much data points, but conceptual points, which is really where you've placed the question. One is the link to new revenue streams. So if one's linking it, for example, to carbon markets or biodiversity markets. That's the conversation going on in Gabon, for example, at the moment, as well as elsewhere. Is one making investments that KPIs are driving new revenue stream generations? That becomes a piece of the story that is quantifiable in a useful way. Reduced vulnerability. I mean, there are many differences between Bangladesh and the Netherlands, mainly that the Netherlands is more underwater than Bangladesh, and the difference is investment in resilience infrastructure. And so clearly KPIs that are linked to investments in resilience infrastructure, particularly on coastal, but also in other contexts, becomes an important way of thinking about building productivity and reducing solvency risk and sovereign risk. And of course, all the links to improve productivity. And then there are a range of ways too. So actually, these are sort of plonk obvious, if I can put it that way, and sort of remove us from a sort of conceptual rarity to understanding that KPIs can link to ways in which productivity and economic prosperity can be driven, both directly and indirectly, in a sense, through investments in areas that also address climate and nature issues. So I think that's there. Maybe we need to have many more KPIs. There's a lot of more analysis to do, but I don't think it's an unreasonable proposition to see KPIs linked to that. And I just want to make one final point, riffing a little bit off of Caroline's observation. We've, I think, in a sense, quite usefully distinguished between use of proceeds and KPI-linked instruments. And I think Caroline is making the point, it's a spectrum. That actually, if use of proceeds begins to derive a premium in the market, then actually you've got this spectrum of sort of no premium through to explicit KPIs linked to reduced debt servicing costs. And I think we can begin to see actually not a smudge, but a sort of spectrum of different ways in which improved and reduced debt servicing costs link to whether it's use of proceeds defined or KPI defined outcomes.
I mean, it did sound to me, though, Simon, from the examples you gave, that the strong links to sovereign risk are not really going to be happening through decarbonization objectives, unless decarbonization happens through taxation and you can somehow link the revenues directly, right? So this is more about adaptation and about conservation of critical resources.
So I certainly think that for lower and middle income countries, where actually the principal issue is not decarbonisation, the principal issue is adaptation and resilience, I think you're absolutely right. And I think in a way the growing interest in this area is more geared towards that agenda, because that agenda is becoming more and more important in the global policy space. Not reduced to importance of mitigation, but certainly adaptation and resilience becoming a very, very strong part of the conversation now in a way that it wasn't before. I'd love to hear Alex's take on how the mitigation piece of the climate agenda, so the reduced piece, kind of connects across.
Before I do that, can I just add two elements or thoughts on the issuer benefits? One is market access. There was a piece in the FT, as I read on the train coming over, that a quarter of emerging markets are at risk of losing market access to the extent you design an instrument that appeals to a distinct investor class that may possibly be overcome. And the second is, I think there are a number of clear studies showing that these ESG-oriented investors are less prone to flight. Yeah, so in a liquidity crisis, they are more likely to sustain market access, and I think these may be benefits in addition to the greenium, which may not be so compelling that issuers will look at. Now, we've had this discussion throughout producing this paper. I think on the adaptation, the benefit of the SLB is clear. But even on the mitigation agenda, I think we need to look at the various scenarios for OECD countries, that sketch the economic costs of a late and disorderly transition. Yeah, to the extent we converge to net zero, it is in our long-term solvency and inherent credit quality interest to do this immediately, smoothly, and urgently. Yeah. Now, this brings forward the fiscal costs, improves the solvency. the late adjustment transition, as some countries, including my home country, Germany, is now maybe embracing, is disruptive, much more costly, and will undermine many asset values to which the public sector is exposed, and growth and fiscal expenditures. Yeah, so I think these macro scenarios that NGFS has done, should inform the value that a commitment to a transition path reflects.
Fiona, anything to add? Fiona, oh, great. Thank you. Sorry, you were muted for a second, but now you're fine. Yes.
What I think Alex is saying is important on the market access. Partly, so one of the important things about the Uruguay bond is that something like a quarter of the investors had never invested in Uruguay before and bought the SLB. So it is important. It's been shown that this can get a new set of investor pool in it, and some of the emerging markets we're talking to, that's really, really important to them as well. Is the increasing pool of investors is really important. Also, fragmentation. And that's why we're looking at this fund structure. We'll put out a blog on this next week. How you can do this in a way that doesn't fragment the markets, because a lot of the countries we work in are really small, really emerging debt markets, and the DMOs don't want funky new instruments that are just going to fragment the market even more when they're actually working on how to really build their markets. So that's, I think, another important part. But on your question on the sort of pricing and the immediacy, I think is what we're trying to do is get the markets to be more forward-looking. And what we're increasingly being asked for from the bank side, we provide a lot of the data that goes into sovereign debt analysis from the credit rating agencies, from the index providers, from the investors, is this forward look. How do we know what countries, not necessarily for the pricing today, but how do we see which countries really are ambitious? Who do we actually reward? Who do we really see building these policies going forward? And that's why I think these forward-looking aspects into these KPIs going out in future, I think is really important. And that, I think, will start to be rewarded into the markets. But it's not there at the moment. We don't have a way of really knowing who's got a really good NDC, who's really going to meet it or not. What are the policies that are being put in place behind that? And as I say, the Uruguay have been incredibly vocal about this. This is a tool that they see to really communicate how serious they are about their GHG reduction and how serious they are about protecting their natural assets. So I see it as a long-term, forward-looking way to get this information into the market rather than arguing about basis points here and there today. It's new investors, it's lack of fragmentation, and it's the forward look on policy that's so key that I think these instruments can unlock.
Final question before turning it to the floor. This one's for Caroline again. Actually, there are two. First, how do you resolve this contradiction that Uruguay was a brilliant success in bringing in a whole new class of investors, and yet we don't see, anything on the greenium and the primary markets? And second, and more pragmatically, ultimately, of course, the objective is to achieve scale. And so, I mean, the way that I would have answered my own question, particularly for the advanced countries, would have been sort of a variant of what Alex said, with an addendum, which is that, look, Jeremy, don't be so obsessed about the greenium and the sovereign risk impacts, because even if there's only a tail risk, maybe that's enough to get you a few basis points. And a few basis points is all that DMOs want, because they are basically bean counters. So I want to know from you, Caroline, how much does a DMO want to see in terms of greenium to really get excited and go to the Minister of Finance and say, look, we should to switch our entire sovereign issuance to SLBs?
Well, as you alluded to, I mean, it could be anything, right? Anything is something, and because of the scale, it can have a huge impact. Just starting off with, with the topic of Uruguay that you mentioned, we've done quite a bit of work talking to issuers after they have come to the market with GSS plus bonds. And in fact, one of the things that they highlight is that, the pricing benefit is a nice to have, of course, but there are multiple other benefits that come with sticking a label on a bond, including, but not limited to, this idea of green market creation. And often in emerging markets, issuing in local currency, for example, okay, this did not apply to Uruguay, they issued in dollars, but if they issue in a local currency, then they're unlocking, the sort of private assets from local investors and bringing those to the green bond market. In the case of Uruguay, as Fiona said, they attracted over 40 investors that had not previously participated in a dollar-denominated Uruguay bond. We recently published on this for the broader market. In the second half of last year, numerous issuers, all types of issuers, repeatedly told us the same thing. Having the green label on their deal enabled the deal to get done in a volatile market, right? And at that point, it's not about a greenium. It's about getting your deal over the line. If you need funding, you've got access to funding if you've got a green label on it, because there's a shortage of that paper. And there's always investors that will come to the market and get involved in those deals. And, in terms of not seeing an outright greenium on the Uruguay SLB, fine, maybe we didn't see an outright greenium. However, if that deal had not had a label on it, it would have probably come even wider. So this is another thing that we have just published on as well, this idea of, if green bonds we're not seeing an outright greenium, how do they compare to vanilla bonds from issuers with similar characteristics? And what we found was that bonds with labels on consistently came tighter to their curves compared to bonds that did not have labels on. So, that's sort of the nuance of that discussion, if you like.
That becomes almost a definitional issue then. Really, the way you describe it, there was actually a greenium, because in the counterfactual, they would have done worse, right? But then there's another way of thinking about that, which is not about the expected return, namely the greenium, but about issuance risk, right? That essentially that you might not be able to access the market at the right time, which has to do not with expected return, but with something else, right? So I guess it could be a bit of both.
Yeah, and that's another benefit of attracting a new and broader investor base. Issuers repeatedly say, as we know, that it gives them greater flexibility when they want to come back to the market and reopen or tap the bond.
Good. So are there questions or comments, please? I would ask you to identify yourself, and we'll take a round. Please, the gentleman in the front row and the lady in the second row.
Hi, my name is Oliver Grimm with the Austrian newspaper Die Presse. I'm the Brussels correspondent here. There's a thing I don't understand, and maybe you can help me grasp it. When President von der Leyen presented the EU Green Deal almost three and a half years ago, she said, well, first of all, the biggest part of the money coming in order to make Europe carbon neutral by 2050 will have to come from private sources. But this is going to be a great investment opportunity, because we're also first of all, there's a huge need in all kinds of green measures, decarbonization measures. And secondly, we're also going to create green bonds, and voila. Now I learned from you that actually, how did you put it, sovereign issues are running out of expenditures they can use the proceeds from. You mentioned the Netherlands, and the Netherlands, to my uneducated eye, seems to be a country that is under huge climate strain. So basically there's lots to invest there, I would assume. And I think you mentioned that actually the taxonomy criteria are very hard to meet. So investors are struggling to find projects meeting the taxonomy criteria. But how big of a problem is it? Who's responsible for it, and how should it be solved? Thank you.
Thank you. Can we have the second question, please?
Thanks very much. Anna Dimitrievich from the European Commission's DG for Climate Action. My question would link the issue of credibility to the remarks on where the biggest interest may lie in terms of adaptation, conservation of resources, in addition to mitigation. So in terms of ensuring the credibility of projects, especially when we are talking about adaptation, it's necessary, in my view, to ensure that experts are involved beyond the financial world, beyond the sort of expertise that you normally find in development banks as well. Because it's very, very interesting to, very easy, to come up with projects on which you can stick the adaptation label, but they may in fact be becoming instances of maladaptation, or at best not delivering much in terms of benefits, whether it's planting the wrong type of trees in the wrong place, or whether it's putting flood defense infrastructure that in fact increases the risk of flooding downstream. But those are the sorts of projects that governments very often tend to propose in the funds that we are dealing with in the Commission as well. So in my view, this is a really important challenge and one that requires attention to the interdisciplinarity when we talk about credibility. And maybe a final point here as well in terms of KPIs linked to resilience as well. Indicators on resilience are not at all as straightforward as on mitigation. And again, this requires parallel work. Thank you.
Yes, these are really excellent points, both questions. Let me add a third one from the online audience. This is the first one that, actually, no, you don't see it, I only see it. The European Parliament has proposed to extend the scope of the EU Green Bond Standard in order to include the SLBs, but this has, she says, discharged. I don't know what she means. I suppose it didn't work out. How do you consider this? So if I can ask the panel to respond, I think the first question was mostly for Caroline. And then the second question, I think mainly for Fiona, as presumably the institution that's going to do all this hard stuff that was mentioned by the question, and of course for Simon, and then maybe on the third point on the EP, maybe you can say something, Alex, and of course also Caroline if she wants to. Caroline, can we get the... Oh, Caroline left. Okay, that's too bad. Okay, who wants to say something on the question on the very extensive initial question? Essentially, the issue that that we might be running out of use of proceeds, and please go ahead, Alex.
Yeah. Okay, so this spot on as you say correctly, the initial expectation was there's a greater mobilization by the private sector dedicated to green projects. I mean, we're clearly now understanding the risks in the investment environment, the unclear policy signals, in particular on renewables, and a greater share likely ending up with the public sector, where the taxonomy alignment is significant, but other issues like social policies, just transition, tax redesign do not fit easily with the established taxonomy. Yeah, so therefore, a greater sense. I quoted some estimates that expenditures need to be handled by the public sector. The investment case is still there, and to the extent there is policy credibility, should be compelling ultimately also for the private sector. Yeah.
Simon?
Offer a variation on Alex's theme. So the critical difference or a critical difference between SLBs and use of proceeds is that the KPI-based approach doesn't require that you spend the money that you've raised in achieving the KPI. Think Amazon and Brazil. Yeah, recovering the Amazon is principally a policy play, not an investment play. It's principally a law enforcement issue, not an investment play. And similarly, we've had situations in use of proceeds deals, where you have a poor country, a low-income country going, we have to spend this money on green, but what we actually want to do is build hospitals. But we now can't do that because we've been forced to hypothecate our funds. The KPI model essentially says, make the KPI deal. Yeah, if you've got to use some of the money that you're raising to do that, all well and good. But if you can increase your fiscal space by doing that, by not spending all that money on those KPI outcomes, you have the opportunity to spend money on other stuff as well that's important. So I think that mental shift from raising money to spend it on X, as opposed to raising money, committing to deliver policy-based KPIs that may or may not need part of that money, I think is an important part of the story. On your specific observation of the Netherlands, since I spend most of my time there, I completely agree with you. Yeah.
Fiona.
Yeah, on the interdisciplinarity. Yes, I really like that question, because one of the reasons I really like working on this topic is that exactly that. I have to reach out and work with my colleagues in all sorts of different departments. So it's actually really, I learn a lot from doing this. So for example, one of the frameworks that we're working on with the country at the moment, with a series of environment and social KPIs that they're working on, exactly, I had to sit down with our water colleagues and really look in detail, exactly as you're saying. The country wanted to set some KPIs around the water, came up with a few, but actually when you sit down with our colleagues who really know the water sector in the country and in the region, they say, well, no, actually, what's really transformative is not this indicator, but this one. This is what they really need to hit to really make the difference and see the sort of transformation that you're alluding to. So I actually think the interdisciplinarity and getting that kind of expertise in to really set the targets that matter, I think is incredibly important for making these sort of instruments robust. And it's, as I say, it's one of the pieces of the puzzle that I actually really enjoy about this work.
It's indeed why we need the World Bank and the other MDBs. I really mean that. Maybe Alex, briefly on the issue of the EU Green Bond Standard, whether it includes or not includes the SLBs. Can you just say what the facts are and?
Well, the way I understood it 3 weeks ago or so is that the verification that is accredited under the new standard would also cover sustainability-linked bonds. I don't know what's happened since then. That's sensible. We need that transparency. I think we're lacking that in the corporate SLB market, and I think it's a good policy ambition to bring this into a more transparent framework, and then private providers can offer the standards, and there'll be greater transparency. They'll be free of conflicts of interest and sort of black box models. Yeah.
Great. So let us close. Thank you so much to all 4 panelists for a super rich discussion. Please look at the 2 or 3 papers. They can be found, well, certainly the Bruegel, the Alex Lehmann's paper with Katharina Markins on our website. The NatureFinance website has the other paper, and we will continue the discussion in the future. It's been very rich. For those that are here in person, there's a little bit of lunch outside, and Fiona, you can get breakfast now. She's actually on the East Coast of the United States, very early there. Bye-bye. Thank you all.